Welcome back to the Crypto News Today podcast. It's Monday, and after what has felt like weeks of fear and resets, the market is suddenly alive again. Bitcoin is pushing higher after a shaky weekend. Ethereum has steadied itself near 4,000. And across the board, altcoins are finding some breathing room. In today's episode, we're going to look at why this is happening and what it means as we step into a new week. There are two big stories to dig into. The first is the simple but crucial question of why the market is pumping so sharply right now. The second is the regulatory shakeup in the United States, where the CFTC has been left in turmoil, and Donald Trump is signaling a friendlier posture toward the industry. Putting together these stories give us a clear picture of why prices are moving the way they are and what could be next. But before we get into that, let's take a look at where the top 10 coins are right now. Bitcoin is sitting just under $110,000 at the time of recording. It dipped below that level late last week, triggered a round of panic, and tested support down at 107,000, but it never broke down, and over the weekend, buyers stepped back in. The bounce has carried it back above 109,500 and traders are watching that 112 zone as the next short-term target. It's a reminder that Bitcoin remains the bellwether. When it holds support and turns higher, the entire market follows. Ethereum is hovering around $4,000 even. It has been a struggle to stay above that line, but holding it today is a small win for the bulls. Ethereum has lagged behind Bitcoin in this cycle, but every time Bitcoin steadies, Ethereum tends to come back with more volatility. If it can hold 4,000 and build momentum, traders will look toward 4,200 as the next level to break. Solana is pinned near the $200 mark. That number has been the battleground for months. Every dip under it has been bought, every push above it has been chased. Right now, Solana is trying to hold its ground. If it can break convincingly through $205, it opens the door to another leg higher. If it fails again, we may see more back and forth in this range. XRP is stuck once more just under $2.80. That wall has been frustrating traders all year. Each time the price approaches it, sellers step in, yet the coin refuses to be knocked down for long. It keeps coming back to test that level again and again. If this rally is strong enough to finally clear it, $3 becomes the obvious magnet, and momentum could accelerate quickly from there. Cardano is steady at 77 cents. It has not surged the way some others have, but it has also not lost ground. Its community remains loyal, and often these quieter periods precede bursts of catch-up performance when the wider market gets hot. For now, Cardano holders are simply glad to see stability. BNB trades at $965. It has been remarkably steady compared to the wild swings elsewhere. That stability has made it less exciting to traders looking for fast gains, but in markets where volatility can cut both ways, a coin that holds its ground has its own appeal. Dogecoin is changing hands at 22 cents. It has risen slightly on the back of the broader pump, but has not shown fireworks yet. Still, Dogecoin has a history of sudden meme-driven rallies, and if sentiment keeps turning, it could see sharper moves. Avalanche is at $28, up modestly. Tron sits at 33 cents, grinding steadily. Neither is dominating attention right now, but both are participating in the overall rebound. Polygon rounds out the top 10 at 71 cents. Like Cardano, it has been more subdued, but continues to hold value and provide a base for developers. That is the snapshot. A board that just days ago looked heavy and fearful is now greener, steadier, and giving traders something to get excited about again. Which brings us to the first big story. Why is the market pumping right now? The simplest explanation is that markets move in cycles of excess and reset. Over the past 2 weeks, crypto was hit with a wave of forced selling. More than $1.5 billion in leveraged long positions were liquidated across Bitcoin, Ethereum, and major altcoins. Those traders who piled in with borrowed money on the analysts across the market have been weighing in on this rally, and several are pointing to a mixture of technical structure, whale activity, and macro drivers that align with the bounce we're seeing. One of the more bullish takes comes from technical analysts cited in Cointelegraph, who argue that a breakout toward $150,000 to as high as $300,000 for Bitcoin is becoming increasingly likely if the coin can clear resistance in the $112,000 to $114,000 zone. Their argument rests on the pattern of Bitcoin lagging gold movements by several months. Gold has already broken higher, and if Bitcoin follows that lagged correlation, analysts suggest we may be in the early stages of a parabolic run. Other strategists echo the technical side but add more immediate price targets. Cameron Asghar, who has been tracking Bitcoin's chart through this cycle, lays out what he calls a three-pump sequence. The idea is simple. Every time Bitcoin retests and holds a major support, the rebound becomes more aggressive. He sees the current bounce as the second leg of that sequence, targeting a move to 120 to 128,000 in the fourth quarter of this year. According to him, that would be the final confirmation that this cycle is not collapsing back into a bear market, but instead re-accelerating into what he calls the super trend phase. Beyond technical charts, on-chain data is also telling a story. Reports from the Economic Times today highlight what they call massive whale accumulation. Over the past week, large holders, wallets with thousands of Bitcoin or tens of thousands of Ethereum, have been buying steadily into weakness. Billions of dollars worth of coins have shifted into long-term wallets, reducing exchange supply. This kind of accumulation often precedes rallies because it takes liquid coins off the market. With fewer coins available to sell, any surge in demand pushes prices higher more quickly. In other words, the whales are quietly voting with their wallets, and they're voting bullish. It isn't just Bitcoin seeing this trend. Ethereum has shown similar patterns of long-term holders adding to positions around 4,000. XRP has seen accumulation near $2.70, suggesting that large holders are positioning for a breakout above the stubborn 280 ceiling. These moves aren't always visible to the average trader in real time. But when analysts piece them together from blockchain data, the picture becomes clearer. Big players are buying, while retail sentiment has been shaky. That tends to set the stage for rallies like the one we're seeing now. Analysts at TradingView, writing for Coinpedia, note that oversold conditions were another important driver. After the liquidation wave, Bitcoin, Ethereum, and XRP all showed technical readings at levels associated with exhaustion. They argue that ETF demand, while not surging the way it did earlier in the year, has remained solid enough to provide a floor. Combine that with improved chart setups, and you have the conditions for what they call a recovery rally. The macro side also hasn't been ignored. Macro strategist Lynn Alden has consistently emphasized that Bitcoin's fixed supply makes it a compelling hedge in environments where governments expand debt and liquidity. With the US facing fiscal battles and the dollar softening, her broader framework suggests that capital is once again rotating into Bitcoin as a hedge against what she describes as systemic currency risk. That's exactly the environment we're in now: political uncertainty, heavy debt loads, and a weakening dollar. And her view adds weight to the idea that this rally isn't just noise, but part of a larger structural move. Together, these analyst perspectives reinforce what the charts and price action already suggest. The rally is not random. It's a convergence of factors. Leverage wiped out, whales accumulating, technical levels holding, and macro winds blowing in crypto's favor. Analysts are increasingly framing this as the early stages of something larger, rather than just a dead cat bounce. Layered on top of this is the role of the US dollar. The dollar had been strong for months, but in recent sessions it has lost steam. Political wrangling in Washington, the threat of a government shutdown, and concern over the fiscal outlook have undermined confidence. When the dollar weakens, investors look for alternatives. Some rotate into gold, others into equities, and increasingly many rotate into crypto. Bitcoin in particular benefits from this dynamic, but the rising tide lifts all boats. As the dollar fell, Bitcoin climbed, and the rest of the market followed. Another factor is technical. Support levels matter. When Bitcoin held 107,000 and did not collapse, traders took note. Each bounce from that level built confidence. By the time the price started to climb back over 109,000, shorts began to cover and momentum traders began to chase. The result was a quick snap higher. In these markets, perception is reality. When enough people believe a floor is in, it becomes a floor. Sentiment also shifted. For weeks, headlines screamed about crypto crashes and bear markets. Analysts warned of deeper falls. Fear dominated. But as the liquidation wave passed and support held, the story changed. Commentators began to call the pullback a healthy reset. They pointed to ETF inflows that had slowed but not reversed, to oversold conditions, to strong hands accumulating. That shift in narrative mattered. Markets trade as much on psychology as on fundamentals. When fear turns to cautious optimism, money starts to flow back in. There is also a political angle. In times of uncertainty, capital looks for hedges. With debate in Washington over spending and the fiscal path forward, some investors moved into crypto as an alternative store of value. It may not be digital gold in every sense, but in these moments, it acts like it. The pump we have seen is partly a reflection of that rotation. So the bounce is not a mystery. It is the result of leverage being cleared, the dollar weakening, technical levels holding, sentiment improving, and political uncertainty pushing capital into alternatives. When those forces converge, the effect can be powerful. That is exactly what we are seeing now as we begin a new week. The second big story takes us to Washington. The Commodity Futures Trading Commission, the U.S. regulator responsible for overseeing much of the crypto derivatives market, is in turmoil. Right now, the commission has only one remaining commissioner, acting chair Caroline Pham. Several others have stepped down or been reassigned, leaving a leadership vacuum. Pham has tried to restructure enforcement unilaterally, but the agency's capacity has been weakened. Staff cuts and internal disputes have further hampered its ability to act decisively. At the same time, the Trump administration has signaled a friendlier stance toward crypto. Whereas previous administrations leaned cautious or even hostile, Trump has aligned himself more openly with parts of the industry. That combination, a weakened regulator and a supportive president, is significant. For traders, it suggests a window of opportunity. The fear of aggressive enforcement that hung over markets in previous years feels less immediate. Markets trade on perception as much as policy. The perception right now is that the regulatory climate in the US is shifting in favor of crypto, or at least away from harsh crackdowns. That perception emboldens both institutions and retail investors. Institutions that were hesitant may see this as the moment to allocate. Retail investors reading headlines about Trump embracing crypto take it as a green light. Whether or not the reality matches the perception, it influences behavior in the short term. This does not mean risks have disappeared. A power vacuum can create uncertainty as much as opportunity. Regulation could swing back the other way quickly. But at this moment, the narrative is supportive. Crypto is not being hounded, it is being tolerated, perhaps even encouraged. That is a stark change from the environment of just a few years ago, and it is feeding into the market's renewed strength. Looking ahead to the rest of the week, the key will be whether momentum holds. Bitcoin must defend support around 107,000. Ethereum needs to stay above 4,000. If they can do that, traders will look higher, toward 112 for Bitcoin and 4,200 for Ethereum. If those levels break down, confidence will fade quickly. Macro data will also be crucial. Jobs numbers, inflation prints, and dollar moves will all influence risk appetite. A hot print could spook the rally. A soft one could extend it. ETF flows remain an undercurrent to watch. If we see consistent inflows, it will reinforce the view that institutions are accumulating quietly beneath the surface. In summary, the pump we are seeing is not random. It is the result of a convergence of forces. Leverage washed out, the dollar weakened, support held, sentiment shifted, and regulation in the US looks friendlier than it has in years. It is Monday. The week is young, and a lot can change. But right now the bulls have the upper hand, and the market has rediscovered its energy. That is where we will leave it today. Drop your thoughts in the comments, hit like, follow, and we will see you at the top.